And once again, I think it's timely to welcome our Amundi experts to understand what markets and investors should make of India's growing role in the global economy. Please welcome our Amundi experts. Thank you for joining us, and welcome back, Vincent. We are joined by Monica Defend. Monica, you are head of the Amundi Investment Institute, and you're here with the head of fixed income and money markets, Amaury. Thank you for being with us this afternoon. So let's get started straight away, and starting with you, Monica. The growth inflation outlook remains the most relevant topic, of course, in the market, driving central bank actions and therefore financial markets. So what are the main themes investors should look for at this point in the cycle?
Yeah, let me give a little bit of framework. We heard about this multipolar context, and we expect economies to run at a multi-speed growth, which means basically US cooling, Europe recovering, India rising, and China stalling. On that, from here, I see main three themes. The first one, the global economy is resilient, but there are some diverging trends. We call them bifurcation that are emerging, which means that we are going to see more uncertainty ahead. The second theme refers inflation and central banks' reaction function. We said that the disinflation trend is set, but probably is slower than what we were expecting, and definitely it is not linear. So the next move for the central banks is to cut, but again, there might be some divergences over time, so they won't be synchronized. Then we have the current economic backdrop that indeed is solid, but it's vulnerable to external shocks. The reason being we have limited fiscal space and there is less geopolitical coordination. So if anything goes south, it will be fast.
Thank you very much, Monica. Vincent, given what Monica has just shared with us, how will these trends affect markets and investors?
Well, the context Monica just described is overall positive for earnings and as a result for risk assets, credit and equities. But it's fair to say that most is already priced in, so it's difficult to find the upside catalyst today, given where prices are. So we'll expect for the coming months rangy markets, but below the surface we will have, we believe, some rotations happening, and as well less stable correlations, until we get more clarity on what is happening on the front of the real economy. Inflation, etc., central bank action. So a kind of transitory period. We anticipate as well, in that context, a relative overperformance of equally weighted indexes, and as well of some forgotten parts of the market. We might catch up on a relative basis, like small and mid cap, wherever in the world, and as well the UK, typically, which has been a forgotten market. Commodities as well, at large, will remain a must in our mind for any allocation, and of course, as always, but more than ever, a focus on quality, and we need to stay agile.
Thank you very much. Amaury, now, where do you see most opportunities now for fixed income investors?
Well, first on bonds and duration exposure. Last year, during the 2023 forum, we told you bonds are back. But we told you as well that you had to stay agile on your duration exposure because the market would keep on balancing between the risk of recession and the fight against inflation. And this is what has happened, with 10-year bond ranging from 190 to 3% over the course of the year. Now, I strongly believe that this last year and a half of range trading will end soon. We will enter, within this summer, a new trend, or downward trend on the rates market on the major G10 currencies, to the exception of Japanese yields. So go long duration now, watch the first central bank cuts and stick with duration. To express this duration call, we recommend to invest into investment credit bonds, which have the best risk return in terms of excess return. And beyond IG bonds, we favor emerging bonds, which has an attractive return profile and will benefit from the Fed cuts on the second semester.
Thank you very much. Monica, now, let's look ahead and let's look at the longer term, shall we? This forum, I guess, is called Adaptation in Motion. Okay, so we have to address the theme of our forum today. What do you think are the main themes investors should play in this world, Adaptation in Motion?
Well, we think that adaptation in motion will be featured with the following theme. The first, geoeconomics. We heard about winners and losers. The outcome of the US election will set the speed of deglobalization of trade policy. The second theme is climate change and scenario analysis. We see this in terms of investment flows needed to implement the energy transition, which is going to have an impact on long-term growth. We see this on rising competition. We just heard on the clean tech sectors, for example, with tariffs on the rise. And then we are going to see it with this disorderly and delayed transition into climate events that unfortunately are becoming recurrent and extreme. If you think about what happened last year in Europe, we had a plus 50% food prices increase because of the heavy rain. So this is something that is going to have an impact on consumers, but as well a worry on central banks. The third theme relates to productivity gains and artificial intelligence. On this front, we are a little bit more tepid than consensus. What I mean is that in order to see really a material impact on total factor productivity, we need to wait. We need to wait from investment in infrastructure to be implemented, probably a little bit of regulation. But over the next 5 years or so, we expect a 0.3% increase in total factor productivity globally. If we stay on generative artificial intelligence, the next step, the real challenge, is to move on healthcare, so applying artificial intelligence to the scientific method. And lastly, high debt and aging population. So we talk about limited space on the fiscal side. This means that individuals will need to take care about their retirement and health needs.
Thank you very much. Now, Amaury, what does this all mean for bond investors? And will the US Treasury remain a safe investment? Now, that's a rhetorical question, isn't it?
Well, US Treasury is by nature a safe investment. So the real question is the shape of the curve, and we believe the curve will steepen. And this for 3 reasons. The first one is that we are behind the peak, and we believe, as Monica said, that the Fed should deliver 2 cuts in 24 and more in 25. The second reason is whoever wins the US election, fiscal expansion, deficits, and Fed balance sheet constraints will lead to more net US Treasury issuance, which should push the term premium to be higher. And the third reason is that even though short-term, we believe that the war and inflation seems to be over, longer-term inflationary pressure through deglobalization, demographics, and energy transition should push as well the curve to be steeper. So for all these reasons, we believe the US curve will come back into positive territory by the end of the year.
Thank you very much. To wrap up now, Vincent, in a world where traditional safe havens may be challenged, what role will emerging markets play, and especially key economies that we've heard so much about today, China and India?
Yeah. So many people in the West, are not us of course, are underestimating the huge progresses and the investments which have been made in Asia at large on technology and the catch-up by many countries. So of course China, but Japan, South Korea, India. And just to illustrate, now China ranks number 1 in all of the 8 critical technologies for energy transition and environment. So that's quite significant. India as well is undergoing a very significant profound transformation thanks to its renewed investment cycle. So overall, we expect an overperformance of the Asian assets. Our capital market assumption for equities is 8% return per year, so much higher than the West countries. And just a word on the bonds. As more and more Indian and Chinese bonds will be included into global indexes, we believe as well that they will become a must and cannot be avoided. So overall, we expect a rebalancing of allocations more and more from developed to emerging. It will take time, but it will happen.
Thank you very much, Vincent, and thanks to you all for your insights. Thank you for being with us, Monica, Amaury, and Vincent, our Amundi experts. Thank you.